All right, this is the audience participation part. Who in the room? Oh, let's do it the other way around. Everybody stand up. All right, anybody who doesn't have a digital wallet yet, sit down. Okay. Everybody who just has a Coinbase account, sit down. 1, 2, okay. Very good. Anybody who only owns Bitcoin or Ethereum, sit down. Okay, very good. Very good crowd. Thank you very much. Okay, so that gives me a little bit of an idea what I can talk about. Everybody can sit down now. So yeah, it's Chris, not Kameir, but Kameir, same difference. I used to sell internet services back in the 80s. I was a software developer before. Then I made the unfortunate decision to become a lawyer. And then was general counsel for an internet service provider back in Europe, hence the accent. We were actually lucky enough to sell the company 6 weeks before NASDAQ hit its all-time high. So I moved here, became chief operating officer of our venture fund. And one of the things that we invested early on was multi-massive online player games and things like voice over IP, Skype, etc. And so the way this relates to this is virtual currencies have actually been around for a very long time. Right? So virtual currencies, everybody who's a gamer in the room probably has dealt with virtual currencies since the 90s. There used to be an exchange rate from the currencies in several multi-massive online player games to the US dollar on a daily basis. Right? So, and also I'm actually personally not a big fan of calling this cryptocurrencies, but it kind of stuck. Really a better term for it would be digital assets. So we'll get into it a little bit. The clicker man. There wasn't a clicker, so we had a man. So what I like to do is typically refer to things that you'll find online and then point out why they are wrong. Makes my job really easy because I really hate doing presentations, so I'll just copy someone else's stuff and then tell you what is wrong with that. Actually, I cut out the wrong part here, so you'll typically find this fintech stuff, and then they have a box here that says blockchain, and then they have a box here that says cryptocurrencies. And as most of you in the room probably know, that's not quite correct, right? So fintech really shouldn't be a thing in most ways, right? So if you take a blockchain, you can create PayPal, you can create Zenefits, you can create basically anything that fintech is about, right? So I found this in the Harvard Business Review, and it says blockchain will do to the financial system what the internet did to media. Actually, it's an understatement, I think. Blockchain will probably do to the internet what this big-ass media did to the dinosaurs, right? So I was part of building the first interweb, like we saw dial-up services 56K. And if you go back in time and you read the stuff that the early inventors, quote unquote, of the internet had in mind, it was never meant to be what we have today, which is really the commercial web, right? You got a few companies providing access, and on top of it, you get a few companies that give you visibility, right? That direct the eyeballs, etc. So in essence, we have the commercial web, not the World Wide Web. So my hope is with blockchain, we can fix that. So this is another slide you'll typically see in the mainstream media, like what blockchain addresses, like the digital currency part, the record keeping part, the security part, smart contracts, which most of you know that has been introduced by Ethereum. For whatever reason, the guys that created this one put crowdfunding here, which is really part of smart contracts. And as most of you, I hope, know, Ethereum right now is a little bit of a one-trick pony, right? So it's the platform where ICOs happening. And we'll talk a little bit about ICOs. We're still getting our groove on here. So if you look at the financial industry, those are like clearly in the path of blockchain, and not so much actually in the United States. And the reason why I'm saying this, most of you in the room probably have a credit card in your pocket, you have a bank account, but actually this is the bubble. That's actually the bubble that needs to burst. It's not the Bitcoin bubble, it's not the blockchain bubble. The bubble is we here. We live in a bubble, right? We live in a bubble called the United States. Then within that bubble is another bubble called Los Angeles, California. And so there's 2 billion people out there that never had a bank account, right? And they had never, we talked about this earlier with someone here, they never had a phone coming to their hub, right? So now they have a cell phone. They have a smartphone, and they never had a bank. They probably never even had an identification card of sorts. Guess what? They never will need one. So just like they skipped over the step where you had a phone that was connected with wires to the wall, they skipped over the step where there was a wall that said bank, and they had to walk into the bank, pull out an ID to then justify the fact that I can give you my money, you hold on to it when I want it back, right? So banks and a lot of these financial processes that we integrated, they are the classical middleman. And most of the world will never have to deal with the classical middleman. It's entirely cultural hypnosis that we are under, that we need this, right? The world started out as a peer-to-peer system, and we're going back to being a peer-to-peer system. So this is what happened last year. I assume most people paid somewhat attention to this. The reason, and the only reason why I'm bringing this up, this is a list of the top 10 ICOs, and they raised about 40% of the total volume. So what that means is that the rest, the 225 ICOs that haven't, raised on average $10 million, right? So there's a lot of talk about how mainstream popular people are being scammed out of their money. The reality is no mainstream person was harmed in the conduct of an ICO, right? Because it's actually pretty complicated to take part, as most of you in the room know, right? You've got to establish a digital wallet, you get some Ether into your account, and now, as of the end of last year, a lot of these ICOs won't even let you take part in the ICO if you're in the United States. You're arriving at the site and will say, well, you're coming from a US IP, we don't want your money. Right? And that's part of the regulation that we'll talk about. The only thing that I want to point out is if you see these lists, they're typically reported in USD, which makes no sense whatsoever because none of these companies obviously raised USD. Actually, it's not quite true, like Tim Draper and a couple of the other traditional VCs put actually fiat currencies in some of those projects. That's a different story. But let's take one example, Tezos. They are typically listed at 232 million, but this is actually what they raised once the ICO was over. So if you do the math and you look up the price today and you add up those two numbers and you assume that they didn't liquidate most of that cryptocurrency, this is worth a little over $1 billion at the moment, as of this morning. So this is just a quick comparison. Obviously, it's not worth much, but if you had invested in real estate last year, would have made 5%, gold 10, global equities 18, and this is all digital assets combined. Right, so this is why VCs now finally start to look at this space more serious, because even if they had just had put 5% of their portfolio on there, they would have had a much better year than they did. So one thing that people get wrong on a daily basis that I have to correct in talks with lawyers and accountants on a daily basis is basic blockchain economics. Like there's often this talk now that if you read any ICO literature, hey, we have a utility token, right? So we don't want to be a security, we don't want to get in trouble with the SEC, we have a utility of sorts, and then they make an argument for that. Well, if you can't actually use that token right after you bought it, right after it's given to you, there's no way that's a utility token. None of the regulatory agencies will let you get away with that. So then the other challenge that most of these tokens have, they're created on the Ethereum blockchain. So there's no problem with this if you're just using the token as is versus you're trying to run your software on Ethereum. Anybody know why? Anan? Okay, you should know. Okay, anyway, we'll get to that. It's right here actually. Transactions cost money, right? And if you have a project where you propose, hey, I'm gonna digitize all your healthcare data. I put your first name there, I put your last name over here, I put your date of birth there, and all your conditions over there, so it's super secure. Well, every single one is a transaction. So if you're doing it on someone else's blockchain, you have to pay for every single transaction to be encrypted. So transaction costs money. And also transaction take time, right? As most of people know, there's a block formed on Bitcoin approximately every 10 minutes, not exactly, but approximately. And a block is not one transaction. A block is many transactions typically. Anybody know what the current reward is for creating a block? 4.5 what? 12 point, yes, the gentleman is right, $12,500 for creating a block, which halves every 210,000 transactions. There you go. So blockchains obviously evolve rapidly, so it's always funny to see people say, hey, Bitcoin is a fad. That's like saying Linux is a fad, will never go anywhere. Well, you're shooting at a moving train, right? It's developing every single day. So to say, well, it's only supporting 4 transactions per second, yeah, that's right now. And that's the main chain, who cares, right? It's the gold. It doesn't make a difference. It's people who put out these statements, they're not actually saying anything. That's just treating every version of Linux like it was the exact same copy of the previous version. It's changing every day, which is very, very important to understand. So I assume most people in the room understand the concept of forks, but for those who don't, I'll explain it real quick. So every time the core developers make an update and want to push it out to the miners, so the people that create transactions on the blockchain, the miners have the right basically to veto it. The majority of miners has to agree to implement this code change into their own system in order for this new blockchain or this new version of Bitcoin to occur. If they don't, nothing happens, the code gets rejected. If a significant portion, however, decides, hey, we want to do this, we think this code is significantly better, and they deviate from the main chain, then you create a new Bitcoin. So this is how Bitcoin Cash was born. This is what created Bitcoin Gold. So the miners on some of the chains, not on all, are in control because not only the developers decide what happens with the code bases. Did we skip the gas slide? Really? I spent so much time on that. Okay. All right, so the main transaction chain right now, although it's really mainly used for initial coin offerings, as you most know, is Ethereum. And the transaction cost on Ethereum is called gas. And gas costs vary, and they vary based on demand. So if there's a very high velocity ICO happening, demand spikes. So every time I do this presentation, I pull up the current gas price. So this morning it was on average 6.3 cents. Again, if you have to perform a lot of transactions based on the system that you're proposing to do on that particular blockchain, you have to pay this transaction fee. If you have to do it faster, you have to pay more. Because every transaction, you decide how fast you want this transaction to be recorded. There were really high spike prices. Last time I spoke about that, it was almost at 96 cents per transaction. That's a lot of money if that's the cost you need to pay to create one entry in a database. So there's public networks, that's what I've been talking about so far mostly, and then there's private networks, like the most prominent one being Ripple, supported by very large corporations right now. Pretty successful, although it's kind of the paradigm between Linux and Windows. And in my understanding of the world, the way evolution works, it's called the law of requisite variety. The most flexible in the system will eventually dominate that system. So we'll see how this plays out here, but as most of you know, Linux is really running the World Wide Web. Open source is running the World Wide Web. You don't pay for your web server, you didn't pay for your browser, you don't pay for email typically. All these protocol layers are free to you to use and are free for developers to enhance, provide new products, create new systems on top of them. So the one thing that's interesting about all these discussions on ICOs is that typically when the regulators move in, no one understands the basics, how really money changes hands. And that's what I'd like to encourage everybody to understand. So to understand basic economics and how money is actually being transferred. There's only so many ways of doing this. So a lot of systems, let's call them that, protocols were funded by so-called donations. So someone set up a foundation like the Ethereum Foundation, and then they collected donations to build that particular network. That's fine if you can believe it, if you don't make a profit on it. And the IRS might judge it differently in the United States if you ever touch it as a US citizen. Then if you run an ICO and you decide, well, I'm just going to borrow this for a while, build my system and give it back, you could call it a loan, or what most are trying to do is stay right in this bucket. They're trying to do a crowdfunding. So typically when you read about an ICO, they will also refer to it as crowdfunding, i.e. pre-selling a service that I'm telling you I'm going to build. Right? Which is then different from being an equity, and that's what everybody is trying to stay away from, because there's a lot of hurdles to overcome if you want to do so. You can't actually be promoting it, or you're in a very small bucket of regulation that won't allow you to raise a whole lot of money, and I can talk about that at a separate seminar altogether. So this is what we have currently in the United States. And this is also the reason why most of the token development is not happening in the United States, because the short explanation of this slide is there's huge uncertainty, right? So the IRS is taxing virtual currencies as property. So what that means in effect is every time there's a Bitcoin transaction, it's a taxable event of sorts, right? So you got rid of it. How much did you buy it for? How much did you get in return? It makes no sense whatsoever, right? It's super hard to obviously keep track of that. And if you're a Coinbase customer, hopefully you saw that if you have more than $20,000 in transactions, they will report your data to the IRS. But I think it was 2 years ago by now, the IRS approached Coinbase, and that was a year after the IRS declared, hey, virtual currency is property, and you should be declaring income tax or property tax on those transactions. Well, a year later, they looked at the incoming returns, and they had 8 returns, and decided, well, Coinbase has 1.6 million customers. I don't think they all filed a return. So they subpoenaed Coinbase and wanted all of their data. Coinbase forwarded just a little bit and ended up just granting them the access rights to data for every customer with more than $20,000 in transactions that year. I wanted to talk about that legal slide forever, but okay, never mind. Well, we can go, okay. He saw you aboard, so. No, go on, you decide, it's your show. All right, so speaking of basics, right? So again, that comes back to what I said initially. So I'm actually not a big fan of cryptocurrencies per se, as far as the term and also as far as the focus that it's being given. Internally, we typically refer to it as digital assets, because this is really the properties you should be looking for if you're looking at money, right? So you got the typical medium of exchange, you got a unit of account, and the store of value. And yes, some of the currencies, and maybe even most of the currencies out there that people call currencies, will fit all of these criteria. But a lot either don't fulfill all of these criteria, or they have many more important aspects that make them useful, and that's why people buy them, that's why people use them, that's why people exchange them, and not because it's a medium of exchange or a unit of account or a store of value. And honestly, most early contributors, specifically in the Ethereum case, they basically voted with their money. They gave their fiat to a project because they wanted to see this project in the wild. They wanted to see this become alive, just like in any open source developments, usually the developers come together, they contribute their time, they develop something because they believe in it. And so this is the same reason for a lot of the early projects that went into protocols for people to actually take their fiat and convert this into this quote-unquote virtual currency. So this is what we have now, and I assume most people know that this was originally tradable or exchangeable against a certain amount of silver in the same spot it says now, "In God we trust," and it's called fiat, which means just let it be done. So by decree we declare this is money, and we'll just keep making more of that, which also means that this is the actual value that's being created. Not much. So you probably all have pennies laying around someplace, probably not in your pocket, because there's nothing you can buy with a penny. Initially, the penny was created because you could buy something with it. You could buy something with a nickel, you could buy something with a dime. Well, count the items you can buy with those items today, with your coins. Not all that much. Most people don't bother carrying them around anymore, right? So that had this one guy thinking, this is the anonymous Satoshi Nakamoto, which people think may or may not exist or may not be a group. But I encourage everybody to at least read a couple of pages, and actually it's only 9, of the original white paper of Bitcoin. So all the important concepts, aside from the smart contract, are explained in that particular white paper. So it's peer-to-peer, electronic cash, has a digital signature, is hashed on an ongoing chain, and it is using proof of work. Means I'm expending energy in order to record this, and because I'm doing so, I'm participating in a little game, I'm harnessing that reward from that particular proof, because I'm spending the energy. And it takes a lot of energy now to create a new block. It's basically only done now by professional entities that only do that, spending a lot of power. So that's the last slide, and then I make it very open for lots of questions. So Bitcoin is now traded on the largest commodities exchange, which is the Chicago Mercantile Exchange, as future, which is semi-important because what's more important is that Switzerland is rolling out 11,000 Bitcoin ATMs. Like I always like to say at this point in time, aside from chocolate and cheese, Switzerland is basically a large bank. And that's my last slide. Questions?